Welcome to the Financial Frontiers channel, your gateway to understanding the world of finance. Today, we're embarking on an exciting journey to decode one of the most vital concepts in finance: interest rates. We'll be dissecting what they are, exploring how they work, and discussing why they hold such significance in our financial lives. A fascinating world of percentages and profits awaits us. So buckle up as we dive deep into the world of interest rates. Interest rates, a term you've probably heard 1,000 times, but what exactly does it mean? Let's break it down. At its core, an interest rate is the cost of borrowing money. Think of it as a rental fee. When you borrow money, you're essentially renting it from the lender. The interest rate is the rental fee you pay for the privilege of using someone else's money. But interest rates aren't just about borrowing, they're also about saving. When you save money in a bank or other financial institution, you're essentially lending it to them. In return, they pay you an interest rate. This is your reward for saving your money with them, instead of spending it or stuffing it under your mattress. So, whether you're borrowing or saving, interest rates are a key part of the equation. But where do they come from? Well, they're set by central banks, like the Federal Reserve in the United States or the Bank of England in the UK. These institutions adjust interest rates to help manage the economy. When they want to stimulate spending and investment, they lower interest rates, making borrowing cheaper. When they want to cool down an overheated economy, they raise interest rates, making borrowing more expensive. Let's illustrate this with an example. Imagine you're taking out a loan to buy a car. If the interest rate is high, you'll end up paying a lot more for the car than its sticker price. But if the interest rate is low, the total cost of the car will be closer to the sticker price. On the flip side, imagine you're saving for a down payment on a house. If the interest rate on your savings account is high, your money will grow faster, helping you reach your goal more quickly. But if the interest rate is low, it will take longer for your savings to grow. In essence, interest rates are the price tag on the money you borrow or save. Now that we know what interest rates are, it's time to understand how they work. Think of interest rates as the price you pay for borrowing money. Or if you're on the other side of the table, it's the reward you receive for lending money. But how is this price or reward calculated? That's where the mechanics of interest rates come into play. Interest rates can be calculated annually, monthly, or even daily. This frequency is known as the compounding period. The more frequently the interest compounds, the more you'll end up paying or earning. Let's take an example. If you borrow $100 at an annual interest rate of 5%, in a year, you'll owe $5 in interest. But if that interest was calculated monthly, you'd owe slightly more than $5 at the end of the year, because each month, the interest gets added to your balance, and then you're charged interest on the new, larger balance. This brings us to a crucial distinction in the world of interest rates: simple versus compound interest. Simple interest is straightforward. It's calculated on the principal, or the initial amount of money, and doesn't change over time. Using our earlier example, if you borrow $100 at a simple annual interest rate of 5%, you'd owe $5 at the end of the year, no matter what. Compound interest, on the other hand, is a bit more complex. It's calculated on the principal and also on the interest that has previously been added. So if you have the same $100, but now at a compound annual interest rate of 5%, you'd owe more than $5 at the end of the year. That's because the interest is added to the principal, and the next interest calculation is based on this larger amount. Although the difference between simple and compound interest may seem small, over time it can have a significant impact. When you're borrowing money, compound interest can make your debt grow faster than you might expect. On the flip side, when you're saving or investing, compound interest can help your money grow at an accelerated rate. So when you're dealing with interest rates, always consider the frequency of compounding and whether the interest is simple or compound. These factors can greatly affect the total amount you end up paying or earning. In summary, interest rates are far more than just a percentage. They're a tool that can impact your financial life in significant ways. Depending on how they're applied, they can make your savings grow, or they can make your debt increase. It's crucial to understand how they work so you can make informed financial decisions. So, interest rates aren't just a percentage. They're a tool that can either make your savings grow or your debt increase. Interest rates are not all created equal. There are several types, each with its own characteristics. First up, we have fixed interest rates. As the name suggests, these rates are constant. They stay the same for the entire duration of your loan or savings account. So if you're a borrower, you'll always know exactly how much you have to pay back each month. And if you're a saver, you'll know exactly how much you'll earn from your savings. Fixed rates offer stability and predictability, but they may not always be the most competitive rates available. Next, we have variable interest rates. Unlike fixed rates, variable rates can change over time. They're usually linked to an index like the prime rate or the LIBOR, which can go up or down depending on economic conditions. For borrowers, this means your monthly payments can fluctuate, and for savers, your earnings can vary. Variable rates can be a bit of a gamble, but they can also offer the chance of lower payments or higher returns if rates fall. Finally, there's tiered interest rates. These rates depend on the amount of money in the account. Typically, the more money you have, the higher the interest rate you'll earn or pay. This can be beneficial for savers with large balances, as they'll earn more interest. But for borrowers, this can mean higher interest payments if they have a large loan. To add one more to the mix, there are also compound interest rates. This type of interest is calculated on the initial principal, which also includes all of the accumulated interest from previous periods. It's like interest on interest, which can quickly grow your savings or your debt. Different types of interest rates offer different benefits and risks, so it's crucial to understand them before making any financial decision. Remember, knowledge is power, especially when it comes to your finances. You might be wondering, why should I care about interest rates? Well, whether you're an economics aficionado or just someone trying to manage your finances, understanding interest rates can be quite beneficial. Let's start with your personal finances. If you've ever borrowed money or saved in a bank, you've directly experienced the effects of interest rates. For instance, when you take out a loan, the interest rate determines how much extra you'll pay back over time. The higher the interest rate, the more you'll end up paying. This is why it's so important to shop around for the best rates when looking for a loan or mortgage. Similarly, if you have money in a savings account, the interest rate determines how much your money will grow over time. The higher the interest rate, the faster your savings will grow. So, if you're saving for a big purchase or just for a rainy day, a higher interest rate can help you reach your goal faster. But interest rates don't just affect individual savers and borrowers, they also have broader economic implications. Let's take a look at how. In essence, interest rates are a tool used by central banks to control inflation and stabilize the economy. When the economy is overheating, with prices rising too quickly, central banks can raise interest rates. This makes borrowing more expensive, which can deter spending and slow down the economy. On the other hand, when the economy is sluggish, central banks can lower interest rates to encourage borrowing and stimulate spending. Moreover, interest rates can impact exchange rates, which determine the price at which one country's currency can be exchanged for another's. Higher interest rates can attract foreign investors looking for the best return on their investments, leading to an increase in demand for the country's currency. This can cause the currency's value to rise, which can affect the price of imports and exports. As you can see, interest rates can have a significant impact on both your personal finances and the broader economy. They influence how much you pay for loans, how much your savings grow, and even the price of goods and services. Understanding the role of interest rates can help you make more informed financial decisions and give you a better grasp of economic trends. In conclusion, interest rates are more than just numbers. They're powerful economic forces that can affect your personal finance and the economy at large. Whether you're a borrower, a saver, or an investor, understanding interest rates can give you a leg up in managing your finances and making smart financial decisions. So, the next time you hear about interest rates in the news, remember, it's not just economic jargon, it's a vital part of our financial world. Interest rates are not just a concept to understand, they're a tool you can use to your advantage. They can be your best friend or your worst enemy, depending on how you play your cards. So, let's talk about how to use interest rates to your advantage, shall we? First, let's talk savings. When interest rates are high, it's a great time to save. Why? Because the higher the interest rate, the more money you'll earn from your savings. Think of it as a reward for being a good saver. So, if you've got some money sitting around and interest rates are looking good, why not put it in a savings account or a certificate of deposit and watch it grow? Second, borrowing. Now this is where things get a little tricky. When interest rates are low, it's a good time to borrow. You'll pay less in interest, which means you'll have more money in your pocket. But remember, borrowing isn't free money. You'll need to pay it back with interest. So before you borrow, make sure you can afford the repayments. Now let's talk about choosing between fixed and variable interest rates. Fixed rates stay the same for the life of the loan, while variable rates can change. Fixed rates are great when interest rates are low. You'll lock in that low rate and it won't go up, even if interest rates increase. On the other hand, variable rates can be risky, but they can also pay off. If interest rates drop, so will your rate. But if they rise, your rate will too. So which one is better? It depends on your risk tolerance and your predictions about where interest rates are headed. Lastly, let's not forget about investing. Interest rates can affect the value of bonds. When interest rates rise, bond prices usually fall, and when interest rates fall, bond prices usually rise. Why? Because newly issued bonds will have a higher coupon rate, making existing bonds with lower rates less attractive. So, if you're thinking about investing in bonds, keep an eye on interest rates. Remember, using interest rates to your advantage is all about timing and strategy. It's about knowing when to save, when to borrow, when to lock in a rate, and when to take a risk. It's not always easy, but with a little bit of knowledge and a lot of patience, you can use interest rates to your advantage. By understanding and strategically using interest rates, you can make informed decisions that can lead to financial success. So don't just sit there. Start using interest rates to your advantage today. As we wrap up, it's clear that interest rates play a vital role in our financial lives. Today, we've dived deep into the sea of finance, unraveled the mystery of interest rates, and emerged with a wealth of knowledge. We started by understanding what interest rates are, the cost of borrowing money, or the reward for lending it. We then navigated through the mechanics of how they work, revealing that they're not just random numbers, but intricately tied to the ebb and flow of the economy. Next, we explored the different types of interest rates, from fixed to variable, and compound to simple. We discovered that each has its unique characteristics, advantages, and disadvantages, and the choice depends on our individual circumstances and risk appetite. We then delved into why interest rates matter. We learned that they're the unseen force that shapes our decisions, from buying a house to investing in stocks. They're the heartbeat of the economy, influencing growth, inflation, and employment. Finally, we discussed how to use interest rates to our advantage. We learned that by understanding and anticipating changes in interest rates, we can make informed decisions and optimize our financial strategy. Thank you for joining us on this journey through the world of interest rates. Here on the Financial Frontiers channel, we believe that understanding finance is the first step towards financial freedom.